I will correctly refer to it as base currency because it is not money. It is currency, and as we've learned, there is a big difference. Money has to be a store of value and maintain its purchasing power over long periods of time. We learned in episode 1 that earlier in our history, our paper currency was just a plain check. It was a representation for real money of intrinsic value, the gold and silver that was held on deposit at the Treasury. You could walk into any bank and slap your currency, like say a $20 bill, on the counter and redeem it for real money, a $20 gold piece. But now, this base currency that's piling up back here is really nothing but a receipt or a claim check on an IOU, that bond. So it's really nothing but a supply of numbers. The Treasury then deposits the newly created currency into the various branches of the government. And the politicians say, hey, thanks for that. And the government does some deficit spending on public works, social programs, and war. The government employees, contractors, and soldiers then deposit their pay in the banks. Now this may come as a shock to you, but when you deposit your currency with the bank, you're not actually depositing it into an account to be safely held in trust for you. Instead, you're actually loaning the bank your currency. And within certain legal limits, they can do with it pretty much anything they please. This includes gambling in the stock market and loaning it out at a profit, of course. Now this is where the machine of currency creation really gets cranking, because this is where something called fractional reserve lending comes into play. Fractional reserve lending is exactly what it says. The banks are allowed to reserve only a fraction of your deposit and loan the rest out. Although reserve ratios may vary, I'm going to use a 10% reserve ratio as our example. If you deposit $100 in your account, the bank can legally take $90 of it and loan it out without telling you. The bank must hold $10 of your deposit in reserve just in case you want some of it. These reserves are called vault cash. But why does your bank account still say you have $100 if the bank has stolen $90 of it? Because the bank left IOUs it created called bank credit in its place. Now I know this sounds crazy, but here it is in black and white from the Fed. Commercial banks create checkbook money when they grant a loan simply by adding new deposit dollars in accounts on their books in exchange for a borrower's IOU. These are nothing but numbers that the banks type into their computers. And even though these bank credit IOU numbers are very different from base currency numbers, because they only exist in computers, they are still currency. So now there is $190 in existence. Now, the reason people take out loans from the banks is to buy something. They're going to buy a house or a car or something like that. So the borrower takes the $90 that the bank loaned him from your account, and he pays the seller of the item. But then the seller deposits that currency into his account, and his bank loans out 90% of that and leaves bank credit numbers in its place. So now there's $271 in existence. This process repeats and repeats until under a 10% reserve ratio, an initial deposit of just $100 can create up to $1,000 of bank credit, all backed by $100 of vault cash, just 10%. But as I said, reserve ratios vary wildly. On some deposits, it's 10%, on others, it's 3%, and on some forms of deposits, reserve requirements are 0. The result is that the expansion of the currency supply by the banks is far greater than even this example would lead you to believe. So once again, when currency is deposited in the banks get to lend it out, and then it gets redeposited and relent, redeposited and relent, redeposited and relent over and over again, creating bank credit all the way. This is where the vast majority of our currency supply comes from. In fact, 92 to 96% of all currency in existence is created not by the government, but here in the banking system.